Today we are jumping into one of the wildest financial stories in the aerospace sector this quarter.
It has to be.
I'm talking about the sudden, really dramatic drop in SIDU space, ticker SIDU.
It was a shocking move, especially right after the holiday. The stock just collapsed, and the noise online was, it was deafening.
Totally. You had one camp just screaming, panic, get out, total disaster.
And then almost immediately you had another group saying, wait a minute, is this a massive discount?
That polarization was instant. And that's what we're here to unpack. Our main source today is a really detailed analysis report that zeroed in on that moment of, well, maximum fear.
Right.
Okay, so let's get into it. Our mission here is to strip away all that emotion and find the mathematical truth behind this drop. Was this just panic selling, or did it create a really clear discount entry for smart capital?
That's the billion-dollar question, isn't it? We're going to use this analysis to synthesize the key facts and, really assess the risk-reward setup for you. We need to get not just what happened, but why the market reacted with so much violence.
And what that volatility tells us about the company's real floor.
Exactly.
So let's start with the panic itself. Let's look at the headline numbers, because this is what terrified anyone holding the stock.
Yeah, if you just check your portfolio on December 26th, the numbers were brutal.
They were. The stock ultimately closed down 12.27% at $1.93.
But just looking at the close totally misses the story. The real horror was the intraday session.
Exactly. This wasn't some gentle slide. It was a complete roller coaster. SIDU rockets up in the morning, hits a high of $3.38.
Which is a huge move.
A huge move. And then it suffers this violent, sustained flush all the way down to a low of $1.76.
Wow. Think about the mechanics of that for a second. That's nearly a 50% drop from the high of the day to the low. That level of volatility, it's almost designed to induce what the report calls maximum fear.
It traps people.
It absolutely traps the retail traders who chase that morning rip. It forces them to just liquidate at the bottom out of pure dread.
So that kind of emotional selling is precisely what this analysis report suggests creates the opportunity. The big question for us then is, was this fear justified? Was there some disaster?
Or was it triggered by something structural, something you could actually quantify?
Because if it's quantifiable, the pain is temporary.
That's the pivot point. We have to get to the root cause. If it was, say, a lost contract or some big failure, the sell-off makes sense.
But if it's mathematical,
then the stock is probably just deeply, deeply oversold.
Okay, so let's get right to that. The root cause. The analysis says this wasn't random at all.
Not at all. It was a required market adjustment based on hard numbers. And what's fascinating is how quickly the market figured it out.
So what was the trigger?
It was actually pretty straightforward. SIDU Space priced a public offering at $1.50 per share.
Okay, so for anyone catching up, a public offering means the company is selling millions of brand new shares.
Right, increasing the total share count and selling them to big institutional investors at a set price.
And in this case, that price was $1.50.
And that's where the math comes in. It's unavoidable. If a stock is trading on the open market for, say, $3.
Like it was that morning.
Exactly. And the company itself announces it's selling huge blocks of new shares for half that price. Well, the open market price has to adjust.
It has to. No rational investor is going to pay $3 when the big guys are getting in at $1.50.
It's just textbook dilution pressure. It forces the price down toward that new institutional floor.
But this is what the report calls out. This painful adjustment. It actually carries some immense good news that just gets buried in all the panic.
It really does. The volatility, it all served a very specific purpose.
Which was removing uncertainty.
That's it. Before this, the market knew the company might need cash, but they had no idea what the price of that future dilution would be.
And now they do. The floor price the company accepted is known, $1.50. That sets a benchmark.
And critically, it solved their immediate capital problem. Now here's where it gets really interesting.
Okay.
The company raised roughly $16 million in gross proceeds from this. For a company like this, an early-stage space company, that cash is it's transformative.
It's not just funding operations.
No, it removes the immediate, existential bankruptcy risk. It ensures they can keep developing their core asset.
The LizzieSat constellation.
LizzieSat constellation.
Yeah.
So the strategic choice they made was clear.
They sacrificed the short-term stock price.
For long-term cash survival and for growth.
Okay, but that strategic choice, the massive dilution to get that $16 million.
Yeah.
That's where the real friction is, right? You're saying the pain was necessary, but isn't that just incredibly bullish? $60 million cash is great, but does the benefit really outweigh the pain for the shareholders who just got diluted?
That is absolutely the right question to ask. The pressure is on now, for sure, but you have to consider the alternative.
Which is running out of cash.
Which is the stock price going to zero. So the analysis focuses on the signal that was sent by the institutions willing to even participate.
Tell us more about that 150 signal.
The fact that sophisticated institutional investors were willing to put up real money at $1.50, that establishes a powerful risk benchmark. They did their homework.
They did their due diligence.
And they concluded that even with the new shares, the company's assets were worth at least $1.50.
And this is so crucial for you, the listener, to understand. It means that as the stock was plunging, when it hit that low of $1.76, the risk to reward ratio for a new buyer improved dramatically. You were only 26 cents above the price that the smart money just guaranteed with millions of dollars.
Exactly. When the market gives you a defined floor like that, the risk side of the trade becomes measurable.
Which is why the analysis calls it a highly asymmetric trade.
Precisely. You're risking a small, defined amount, the distance down to that $1.50 floor, for a potentially much larger reward if the stock recovers.
And we don't have to guess if buyers showed up. The data confirms they did. The stock did not stay in the $70s for long.
And that's your concrete evidence. We saw major strength in the after-hour session. The stock bounced, 5.70% to settle at $2.04?
So once the emotional sellers were flushed out,
informed buyers who saw that $1.50 sell floor, they just stepped in and absorbed the shares. That quick snapback tells you the consensus was shifting from disaster to discount.
So if we connect this back to the bigger picture, the fundamentals, the dilution is the cost of doing business. What you're left with is the asset.
That's the anchor point. The fundamental thesis for SIDU space, their defense contracts, their satellite data model, LizzieSat, none of that has changed.
Right.
Yes, the share count went up, but analysts still have an average price target that's way higher, around $10 long term.
So the market is giving them credit that this $16 million actually lets them execute on the strategy that justifies that future valuation.
It allows them to survive long enough to try.
Okay, so the company is now funded, but the market, it takes time to digest this kind of shift. Let's look at the technical chart and see what it signals for the immediate future.
The chart definitely reflects the chaos. I mean, you see this massive volume spike on the sell-off right at the low.
A capitulation spike.
Totally. So according to the analysis, the immediate technical support zone is clearly that $1.75 to $1.80 center, yesterday's low.
And holding that line is key.
It's crucial for preventing more downside right now, but the major support, the psychological line in the sand, is that offering price.
$1.50.
That's the bedrock. That is what the smart money is watching.
Okay, so if that floor holds, where's the first real battle on the way up? Where's the resistance?
The first major hurdle is getting back over $2.20. That was the key closing price before all this volatility exploded.
So that's where people who bought earlier might be looking to just get out at break even.
It's a natural battleground. If the stock can break and hold above $2.20, the next technical target becomes filling that huge gap the news created.
And filling that gap would take the price back up towards $3.
Which is, substantial upside from these levels. Gap fills are like a magnetic force in these situations. And we also have to look at the indicators. The RSI, the relative strength index, on the intraday chart was just completely crushed. It was heavily oversold after that flush.
So no sellers left.
Pretty much. That kind of setup strongly favors at least a bounce, a short-term reversal, because the selling pressure is exhausted.
Okay, so let's put a bow on this. What's the comprehensive verdict for our listener here, pulling it all together?
The short-term forecast is, mandatory extreme volatility. This stock is going to move, and it's very possible it could retest that $1.75 support zone again.
As the last of the scared money gets out.
Exactly. But the verdict from the source material is pretty clear. This was a strategic move. It was a painful necessity.
The company took the dilution hit to ensure its long-term survival and fund the LizzieSat project.
Which fundamentally stabilizes the whole business. And that leads to the specific actionable setup the analysis suggests for aggressive bulls.
And what's that?
It's considering entries around the $1.80 to $1.90 area, but with a strict, defined stop loss just below $1.50.
So you're defining your risk very tightly against that institutional floor.
You're defining your risk. It makes it that highly asymmetric setup we talked about, where the potential upside to $3 far outweighs that downside risk to $1.50.
It's the definition of a calculated risk. Wow. So we've navigated a really complex event today. We look at that core tension, the immediate painful drop in the stock versus the long-term benefit of that critical $60 million cash raise.
Right. And our central finding really confirms the mathematical truth of it all. This was a classic news sell-off. It was a tactical move by the company.
They prioritized survival and execution over the short-term stock price.
The pain was just the cost of securing the future.
And as we close out, let's leave you with a provocative thought that focuses on what has to happen next. The analysts, they still have this high $10 price target out there.
They do. And now that SIDU space has the $16 million, the market's focus is going to shift entirely. It's no longer will they survive?
It's can they execute?
It's what is the immediate measurable return on that $16 million investment? The viability is secured. Execution is now the only metric that matters.
How quickly do they have to hit those LYSI-SAT milestones to justify even today's price, let alone get anywhere near that $10 target?
That's the real metric to track from here on out.
Absolutely. The money is in the bank. The spotlight is now 100% on performance.